Let's take a look at Tesla's stock and what's happening here. Over the past few weeks, we've seen consolidation. Tesla isn't moving much in any particular direction. We will also look at volatility, support levels, options, and what the derivatives market is telling us. Additionally, we'll examine the volatility smile. I will definitely show you my portfolio and what has changed. Finally, we'll summarize the week. Let's start from the beginning. After the earnings report and the significant rise that followed, with the stock jumping 40%, Tesla began a sideways trend, entering consolidation. It has now been hovering around $175 for several weeks. Let's look at the volatility. Volatility surged significantly before the earnings report, reaching around 60%, and then sharply declined post-report. It continues to decrease, especially for closer expiration dates, because the longer the stock remains in a sideways trend, naturally, the lower the volatility becomes. Currently, we see that volatility is rising both on the upside and the downside. However, the volatility for put options is increasing much more significantly than for call options. This is normal since traders hedge against the stock's decline using put options, which is a completely normal situation. Consequently, put options are more expensive than call options. We will also take this into account when developing our strategy. Additionally, let's look at historical and implied volatility. As we can see, the historical volatility is represented by the gray line, while the implied volatility is represented by the white line. As we can see, the implied volatility is currently below its historical values. This means that volatility tends to revert to its historical levels, and therefore volatility could increase, providing us with an opportunity to profit from it. However, given that the stock is currently in a sideways trend, volatility has decreased. Sooner or later, when the stock starts to rise or fall, volatility may increase again. I always show you strategies that can help you make a profit, and now I will definitely show you another strategy which will be developed with the help of artificial intelligence. Let's take, for example, August 2024. Assuming that volatility will rise by 20%, I base this on the principle that volatility reverts to its historical values. We are constructing strategies solely based on volatility movement, not on the stock's price movement. This is important to note. For example, we can use a strategy where we buy a call option with a strike price of $180 for August and sell a call option with a strike price of $180 for September. This strategy uses different expiration dates. Let me point out that the most complex strategies involve different expiration dates. The most complex strategies involve both different strike prices and different expiration dates, due to varying margin requirements and support levels. As we see, the strategy looks like this. It requires active management, just like all other strategies. If you simply open this trade, you could incur significant losses because the bought call option for August could lead to large losses, unlike the sold call option. I'm showing you this to illustrate how you can play on volatility movements, not to suggest you trade using this strategy. I just want to present you with different options. Usually bloggers show you how to trade by buying and selling stocks. I want to shift your focus to volatility because it is one of the most crucial elements of trading. I don't recommend trading using artificial intelligence, bots, or relying on bloggers. You need to understand the market yourself to become a professional. Let's turn to the most important aspect, which is the volume of options trading. As we can see, the highest volume is concentrated at the $180 level. Let's look at this level. We have been unable to overcome it. We tried on May 15th, but it didn't work out. There were also attempts on May 14th and May 17th, and as we can see, this level remains unbroken. This is mainly due to the massive wall of options at this level. This options wall is effectively preventing the price from moving past it. Let's look further at the stock levels. We have additional levels at $185, $190, and $200. However, as we can see, these levels are not as significant. If we manage to surpass $180, the next target would be $185, which is also a major level, but not as significant. We also have levels at $190 and $200. The ultimate resistance level is at $200. We have tried to break through it many times but have failed. If we suddenly and rapidly break through $200, we could start rising very quickly, potentially accelerating as we did in May 2023. Likely, there were levels back then that were broken, leading to a 66% increase in the stock over the past year, which is significant. We also have strong support levels at $175 and $170. Here, put options are prevalent, effectively preventing the stock from dropping. As we have seen, the stock has tried but failed to break below the $170 level. Why are these levels so important? Again, I remind you that market makers are the primary sellers of options. When you buy an option, the market maker is usually the seller. They hedge their positions to maintain neutrality, which creates significant resistance or support at these key levels. Therefore, understanding these levels and the behavior of market makers is crucial for developing effective trading strategies. A market maker must sell you the option, and thus they need to hedge their unlimited risk. For example, if they sell you a call option, they must buy shares according to the delta of the option. This means that the higher the stock price rises, the higher the option's delta becomes, and the more shares the market maker must buy. This is quite complex. I sometimes explain this in my videos, but briefly, it is not advantageous for market makers to let the price rise above these levels because they would have to start hedging all these sold options, potentially causing the stock to rise even further and faster. Therefore, it's crucial to keep an eye on these levels. They change every week due to the high concentration of demand, particularly for the upcoming week, like May 22nd. We'll likely see significant activity around these levels. Now, let's look at my portfolio. I had a substantial number of positions in AMC, but I closed all of them, locking in profits from the significant rise. Currently, I only have Tesla shares, around 2 in total. That's all for now. Let's move to the spreadsheet. I closed several of my strategies, which brought me a modest profit of around $100 each from 2 strategies. Incidentally, the previous strategy I managed, which was based on Tesla reaching $190, did incur a temporary loss of around $800 when Tesla briefly rose above $190. However, the stock then declined, and I ended up with a small profit of around $100 without taking further action. Overall, my total profit from trading Tesla options is nearly $1,000. As I mentioned, I used the profits from options trading to gradually buy Tesla shares. I currently own 2 shares and plan to buy another next week. The specific share price doesn't matter much because I've already earned enough from options trading to cover the cost. So let's summarize. Today is May 19th, and I am updating my earnings results in the spreadsheet. Currently, Tesla is priced at $177, and I am recording this number in the spreadsheet. Let's review the portfolio's performance. My portfolio has grown by 9%, while Tesla has dropped by 11%, resulting in a 20% difference. Initially, my goal was to reach $10,000 by skillfully managing positions to outperform Tesla stock, which is exactly what I am doing. As we can see, let's look at the chart. The blue line represents my strategy, while the red line represents Tesla's stock price. My strategy shows a very smooth and steady growth, which exemplifies professionalism. It's a gradual, consistent rise. On the other hand, Tesla's stock fluctuates, sometimes dropping, sometimes rising, and currently, it's in a sideways movement. Meanwhile, I continue to make money. With these profits, I will continue to buy Tesla shares, ensuring that at some point, Tesla's stock performance will no longer outpace my strategy. This approach applies to all the stocks I manage, leading to gradual and consistent growth across the board. Everything is fully transparent. You can check the spreadsheet attached to the description. I have shown all this in previous videos as well. I will open additional positions, and the key is not to rush. If you aim to make all the money at once, you will certainly lose money. As you can see, this is a methodical approach. Over several months, I have achieved a smooth, steady growth. Yes, it's not fast, and I don't claim it will be very quick. My portfolio has grown by 10% in 3 months, which is a very significant result. I remind you of my philosophy that it's impossible to predict price movements. I don't know where the stock will go. I have no idea. I can't predict movement. I'm telling you this as openly as possible. Honestly, I don't want any constructions, moving averages, anything else. I think it doesn't work much. And the goal is prudent position management. And I'm showing you again portfolios. So you have to build a portfolio in such a way that no matter where the stock goes, you would make money. This can be done with the help of mathematical analysis. Therefore, if you manage your positions correctly, you will make money anyway. And I'm showing you this by example. As usual, I want to show you a market forecast for this company. Let's take, for example, mid-August. And as we can see, at the moment, the biggest potential is from $165 to $175. So by August, Tesla will likely be slightly lower than it is now. Again, the market is factoring this in. Let's look, for example, at the end of 2024, the Tesla stock will likely be between $160 and $170. So it will drop a little more. Again, here we have the market's derivatives, options market, embedded. It's not me saying the stock will fall. Yes, it's the options market indicating this, and therefore I wouldn't argue with it. There's a lot embedded here. Arguing with the market is not the best idea. Again, based on the options market, I can assume that by the end of the year, a recession might be looming. If it's a severe recession, of course, then Tesla stock could drop to $100 or even lower. So it might seem unlikely, but after 2021, as we can see, the trend for electric vehicles is declining. It used to be very popular. Now, as we can see, for almost 3 years, the stock hasn't been able to surpass its historical highs, although the entire S&P 500 market is currently literally at its historical highs. The same with NASDAQ. But Tesla's situation is much worse. In fact, I think NVIDIA will follow exactly the same scenario. What's currently very popular will eventually become commonplace. When it falls out of fashion or becomes mundane, the same will happen to NVIDIA. It'll be on the sidelines, just like Tesla was literally 10 years ago. I also remind you that my monetization should be approved very soon after this. I'll launch an entirely new portfolio from scratch, where I'll show everything I buy. It'll be maximally open and transparent. Watch this video where I explain the principles upon which my new portfolio will be built. Good luck to everyone.